Good evening, ladies and gentlemen. I apologize for the small delay. Just looking at a small thing here on tools. Welcome to part 2 of our Power Options for Radioactive Trading webinar series. This is the open discussion, the open forum on the Married Put Search Tool. Last week, we went through an hour and 40-minute presentation on using the search tool to identify married put positions in different scenarios, different setups that you can use to identify potential RPMs. Today at the beginning I'm going to review a little bit of that presentation, probably no more than 10 minutes, just showing some basics. Hopefully you all watched the archive presentation that was available. And then of course we're going to handle your questions. Now I just wanted to mention to everyone, I'm going to spend as much time as I have to get through all the questions that you have on using the Married Put Power Options tool to identify RPM trades. But I am going solo tonight, so be patient. It may take me a while to get through all the questions, but we will get through all of them. And please feel free to ask any questions you want. All right, I'm going to spend some time briefly just introducing myself, so let's go ahead and move on. My name is Mike Chupka. I'll be your presenter for this evening. I'm the Power Options Director of Education. I've been with Power Options for 8 years. I handle a lot of the coaching sessions and education on the site, different articles, different blogs. I've co-authored 2 books on options investing, and I've helped Ernie and Kurt edit information in the blueprint, the new updates that come out occasionally, and also some of the information in there as well. Now, Power Options is a patented suite of tools that help you search, analyze, track, and manage your positions. We support over 23 different strategies. I am versed in all strategies on the site. That knowledge, of course, is useful to pass on to you to get further information on the income methods and why certain income methods work and why other income methods that aren't listed in the blueprint do not work as well. And we might talk about that a little bit in one of the later presentations also. I have myself personally been trading radioactively for about 2.5 years. During the webinar last week, we discussed that in my accounts, about 45 to maybe 60% of my investment capital is tied up in RPMs in a given situation. Right now, however, I do only have 2 RPMs open, 2 married put positions open that I've been trading. I'm actually looking to open new positions in the next couple of weeks, and we may discuss that next week. It won't be a recommendation or suggestion. We may look at that next week during part 3 of the research and analysis. I'll walk through how I'm researching and analyzing some of the married put positions that I'm considering opening. Of course, might not be the same at that time as what they are now, but that's what we'll look for. Now, the processes and procedures for tonight's presentation. As I mentioned, I'm going to spend about 10 minutes just reviewing some of the search tool functionality. But this is mainly designed for you to ask any questions you have about using the Power Options search tools for the married put trades, for the RPM positions. So use the question pod on the GoToMeeting technology to pose a question. Please feel free to ask as many questions as you want. Now, I may not have time to answer all the questions. I'm going to try to make time. If we have to stay an extra 20 minutes or an extra 30 minutes, I'll be fine doing that. I'm going to try to answer all the questions that I can. For whatever reason there's a question that I can't get to, then we'll answer that for the group through the blog or through another view as well. The questions can be about, of course, the Power Options Married Put Search Tool, setting up a specific criteria or criteria set. That's grammatically incorrect. It should be specific criterion or a criteria set. The radioactive trading, of course, and the general functions of the search tool. This is just a follow-up from last week's presentation on using the Power Options search tool for the radioactive trades. Now, I do have some basic ground rules. I've never had a problem with this, but we always like to discuss it at the beginning of the presentation. We just ask that you have respect for all attendees and presenters. Negative behavior will not be tolerated. Of course, I want to remind you to be patient. There may be several questions ahead of yours. We will try to get through them all, as I mentioned. And I want to encourage you to feel free to help us help others. If you have an experience or insight, one of our other attendees asked a question about the search tool or about a certain criterion. If you have a different experience based on your market history, your market conditions, use the question pod to send that comment to me, and I'll share it with the rest of the group. Most important, in addition to let's have fun, let's just get some really good education. This is an open forum. I want you to feel free to ask any questions that you have, okay, about the Power Options search tool, identifying RPMs. Feel free to ask anything. Don't hold back and don't be shy. This is designed for you. This presentation is designed for you to get your questions answered. All right, now let me see if I can navigate over to the PowerOptions suite of tools here. Let me do this. This has been causing me some problems here. There we go. All right, let's go ahead and do that. And we're just going to link right over to the main PowerOptions screen. We're going to be using this essentially for our presentation, of course. You know, we talked last week about how we access the search tool. What are we going to do? Well, I've already got my tabs set up for the strategies I want. I'm going to go ahead and click on the Married Put tab. And then we're going to go ahead from there and access the search tool. Okay, and while I'm doing that, I'm going to make one quick change here. Let me just take that out. All right, so that gives us a little bit more room. Now remember, when we first access the search screen, we're going to see a list of trades that match the default criteria. These are not recommendations or suggestions. These are based on the default RadioActive screens, the criteria that Kurt uses when he's first looking to identify his married put trades. When I scroll down below the list of trades, you see that I have the RadioActive default field selected from the search settings saved as menu. Let me highlight that for you. Here we go. All right. Now if you scroll down below the listed trades into the parameter field and you don't see the RadioActive default search, simply click the drop-down menu and select that from the available screens. All right. Now we talked last week, and I put a lot of emphasis on that this tool is designed where you can adjust the criteria based on the stocks that you would like to use. Remember, RadioActive trading is not a strict methodology. It's not a set of rules that says only buy the stock if A plus B equals C. You can use your own stock selection process that has worked for you over time and apply the rules of the RadioActive trading technique on top of that. But when we're doing that, there are three criteria that we don't want to adjust too much, that we want to keep the same rules. The first is the option expiration time frame. This allows us to take advantage of the red line discussed in the blueprint, the radioactive decay line. We're forcing the positions to be at least 150 days out in time. By that I mean the put, the long put that we're buying for protection. We're forcing that to be at least 150 days out in time. You want to keep that as the minimum. You can change the upper level. If I only wanted to restrict it to be 300 days or 360 days out in time, that's fine. But you want to make sure that when you're looking at the all months available expiration, look at least 150 days out in time. Also, we put emphasis on the range in the money. We're not allowing the puts to be more than 20% in the money. The puts we're buying for insurance. This allows us really to take advantage of the ATM bell curve. If we go too deep in the money, of course, we will have a lower risk, but the problem there, remember, what's going to happen? Well, we have a lower risk, maybe only 0.5 or 1% if we go 30 or 40% in the money, but then we have a lower expectancy of profit. And of course, the most important factor is the percentage at risk. The default is between 3.5 to 9%. We're not looking for any positions that have a higher than 9% risk. Now, you can tweak that as you get more familiar with the technique. You might go as low as 2.5% on the low side. You might even in some markets want to go up to 10 or 11% if you're comfortable with that risk. I don't advise that. I've seen Ernie do that in the past. Ernie Zarena, the president of PowerOptions, who also trades radioactively. And my personal criteria, we discussed last week, I'm usually looking for risks between 3 and 7.5 or 3 and 7%. 7 to 7.5% is my maximum risk threshold when I'm using puts for insurance. All right, but the rest of the criteria are pretty much fair game. These three criteria that you don't want to make too much adjustment to or remove from the search, these allow you to take advantage of the three core principles in the blueprint. Okay? All right. Now, if you remember from last week, what are some of the first criteria that I'll change when I'm running my own search? Well, up here at the top in the upper right-hand corner, this is most of our stock information. Kurt's phishing account is based on a $100,000 trading account balance. That's not what I have in my personal accounts, so I usually restrict the stock price right away to look for stocks maybe between $5 and $50 per share or $5 and $55 per share. If you have a larger account and you sometimes find yourself trading stocks up to the $100 or $110 range, you just want to make the adjustment to the stock price based on your filters. Now, there's not a lot of stock criteria that are put into the default radioactive screen. From the webinar last week, we discussed why. Most of the reason why is because Kurt prefers to use this recommended list, the IBD 50 and CanSlim list. So the search is only looking for stocks in the IBD 50 and CanSlim list that match this criteria of that limited risk, not going more than 20% in the money, and at least 150 days out in time on the put option expiration. But if I want to open my search more, I want to use my own criteria. What is the first step I'm going to do? Well, I'm going to select No Lists from the drop-down menu, and then I'll put in some of the fundamental or technical criteria that I use to look for a stock that I feel is bullish in nature. I might use things, as we discussed last week, such as the earnings per share growth, maybe the price to earnings. I might use average broker recommendations. Some of you may throw that to the wind. If I'm looking for dividend-paying stocks, I'll use the dividend field to identify just stocks that pay a 2% or 3% dividend. I might increase my average stock volume, or I might use my market cap, for example. And of course, you can also apply some of the technical criteria, such as the RSI, the Relative Strength Index, or the Bollinger Band ranges. Remind me, well, I'll write it down, but someone try to remind me at the end of the presentation to show you where you can access the Bollinger Band article on PowerOptions to get more insight into how to use these fields, such as %BB20, %bandwidth 20, for example. I'll show you where that PDF is located on the site. Now remember, of course, just in general, the center section, this is mostly our option and combined option and stock criteria, net debit, total maximum risk, our liquidity for option volume today and open interest, the Black-Scholes ratios if we wanted to look for specifically overvalued or undervalued puts. Last week I spent some time discussing why I don't use a specific delta screen or implied volatility, because for me that's already taken care of when I'm using the limited risk field as well. Now, if I did want to use a stock list rather than use my own personal criteria, you could always go back to that IBD 15 CanSlim list. There are other lists available for you. You could screen against the S&P 100 or the S&P 5-star list, for example, Standard & Poor's. Or, remember from last week, we can click on Create and Modify Lists, and this will allow us to create our own personal stock list. So if you have a list of just 50 to 40 to 100 stocks you track on a regular basis, you can create your own list and then look for the RPM positions in your stocks that match that range expiration time frame, at least 150 days out. Keep that risk level nominal between maybe 3 and 9%, or restricted how you like, and don't go more than maybe 20 or 25% in the money, so you still have a relatively strong expectancy of profit. Right? But that was all discussed last week, so you can create your own list. You can use one of the default lists there in the drop-down menu, or you can just select No List and use your own personal stock criteria. Now, from last week, remember we also discussed that what I feel is the best way to create your own search. Let's say I knew right off the top of my head that I was going to look specifically to trade RPMs on stocks that have good fundamentals and pay at least a 3% dividend. Well, the first step I'm going to do, well, I'm going to scroll down to the bottom. I'm going to click Clear these settings. I'm going to empty everything out of the parameter field. And then starting from scratch, I'll go up to my expiration time frame, and what am I going to do? I'm going to keep those 3 core principles, so I'm going to put my days to expiration. I'm going to select all months first from the drop-down menu. Put my days to expiration, let's just say 150 to 500 for right now. That percentage range in the money, I'm going to keep that to less than 20. My maximum risk, I'm going to put in what makes me comfortable. Let's go 3 to 7.5% today. All right, now liquidity I might do next, but typically what I'm going to do is look at the stock price, my personal stock price range based on my account value. Let's go $5 to $55. I'm also going to put in a net debit of less than 55, blank to 55. So I'm only looking for positions where stock plus put is actually equal to $55 or less. All right. I might want some liquidity. Remember we talked last week, if I go further out in time, when I'm looking for options, that are further out in time, I can't expect a lot of option volume today or previous option volume, but I might want to look for some open interest. I'll just use a basic open interest of 10. Now I mentioned I wanted some good fundamentals. I might just look for stocks that have an earnings per share growth of greater than 5%, grown 5% in earnings from last year. Basic price to earnings ratio. Some customers I talk to when looking for bullish stocks or stocks to buy, they'll look for a range of 0 to 50. I'm going to put in a range of 0 to 70. This isn't a recommendation or suggestion, just general ideas. Broker recommendation. Last week we talked about this being based on the Zach scale. 1 is your strong buy, 2 is your buy, 3 is your hold. So if I'm looking for good stocks, I might look for a range of less than 2.8. And what am I looking for again? dividend-paying stocks. Let's put a minimum dividend payment, annualized payment of 2.5%. I want some average stock volume too, and this is measured in thousands. So I'm going to put in 750,000. So my average stock volume, 750,000 shares per day over the last 90 days. All right, and I'm going to use the trend as my friend. So in the simple moving average field, I'm going to just look for stocks that are trading above their 50-day moving average. All right, so I kept my 3 core principal settings in place, put in some basic liquidity values there for the open interest, and put in some basic other criteria, and I am using no lists here. I'm not restricting it to one of those lists. Let me hit submit these settings, and then of course I have the total list of stocks. Now this page will only show me the first page of 20. Down at the bottom we see that we have about 4 pages of results and a total of 69 results that match that criteria. I could continue to filter that using other criteria if I wanted to increase the average stock volume. Maybe I want to look for other things. The historical volatility of the stock, for example, we could make those changes also. Now remember, from what we discussed last week, if I'm using certain criteria in my filter field to identify positions or stocks I want to see, I used earnings per share growth and price to earnings, and I look for the dividend. But right now, those aren't available in the default columns. So just have the company name, the stock symbol, last stock price, and the strike price of the put, days to expiration, the ask price of the put option, my total open interest, the net debit, my total maximum risk, percentage maximum risk, and then my range in the money. See the other fields that I would like to use to analyze my positions. We're just going to click that See More or Less Columns button up in the upper right-hand corner. Here we go. And this will take us to a configuration page where we can pick and choose which data columns we wanted to see. So I had percent earnings per share growth, that PE ratio, and wanted the dividend yield. I have open interest already selected, but I could select things in the option info on the right-hand side, such as option volume today, or previous option volume. Could look at the delta if I wanted to, or the other Greeks. I don't really use those. We explained why last week. Not saying that they're not entirely important or not important. It's just that I feel that most of the criteria that I would use is already factored in by the limited risk field I'm screening for. Okay, but you can absolutely look for those. Bid-ask spread. Okay, I'll just include that. Why not? Let's have the bid-ask spread in there. All right, so I've checked the fields that I want to use. I could select average broker recommendation or the average stock volume also. Let me just do that. And then once I've selected the fields I wish to view, I'll scroll down to the bottom of the configuration page. Let's click Save and Return. We'll be asked to refresh the window. And there we go. Okay, so now the new fields that we have entered. I have my earnings per share growth, my PE, my dividend yield, average stock volume, that's measured in thousands, remember, and of course the bid-ask spread. And these are all pretty small. That's pretty nice. I was expecting maybe to see some there that were 80 cents or 90 cents. There is one that's about a 60-cent bid-ask spread, but that looks like the highest on the first page. Nope, I lied. I'm sorry. There is one here that has a 90-cent bid-ask spread as well. Okay. Now, remember, if I was looking specifically for married puts on ETFs, probably would have used the same processes. I would have hit clear these settings, emptied everything out, but rather than use the stock criteria, I just would have selected the index ETFs and holders list from the recommended list drop-down menu to look for married puts just against those indexes and ETFs. And of course, once you have your criteria set, simply click the Save button, and that will allow you to put in a name and a description for your search. And as you can see, I have several searches here from other webinars. Dividend stocks from January 25th. That was the presentation we did. Not January 25th. Yeah, I'm sorry. Different webinars, and then of course our default searches that you can always toggle back to. So I can always go back to the RadioActive screen after I've created a search. All right, I just wanted to go through that brief review. Ladies and gentlemen, go ahead. Send in your questions. Use that question pod. Queue up your questions for me. What questions do you have about using the PowerOptions search tool for RadioActive trading? Let me know. That's what we're here for today, is to review what we discussed last week, but also at the same time, I want to answer your questions. I want to give you the forum to, if you have any questions about the criteria. If you want to review, for example, what I talked about earlier, why am I not using the implied volatility? Why am I not using the delta when screening for married puts and the RPM technique in the search filters? you want to talk about that percent implied volatility range and why I've been using that recently, you can pose that question as well. So just let me know what questions you have, and I hope everyone did get a chance to join us last week for the presentation, the first part of that our webinar series on using the Power Options tools for radioactive trading, or review the previous webinar as well to get some insight. And if not, you can always go back and view that. Of course, I'm recording this one, and it'll be available there. Okay, well, John posed a question. Mike, how do you then narrow your picks down after your initial screening? All right, well, let's just take this list. When I'm running a search for radioactive profit machines, whether it's, or any strategy, I'll be honest with you, if I'm doing standard collar spreads, for example, or if I'm looking for credit spreads or debit spreads, this basic criteria I created, John, was based on just a few things I was going to look for. I was going to keep my 3 core principles in place: the time frame, range in the money, and my percentage at risk. And then I wanted to look for stocks that have fundamentals that I would like to look for and match the dividend payment that I wanted as well. Now, how am I going to further filter this? Well, I have 2 ideas, well, there are 2 approaches. Number 1, I have 69 total results. Okay? I'm comfortable with the risk level, I'm comfortable with the net debit level, and I'm comfortable with the open interest. Now, some things that I might change at first, I might say to myself, well, first, I could change how I'm sorting the results. Right now I'm sorting them by percentage maximum risk from lowest to highest. But if I just wanted to see the highest dividend stocks at the top, I could select the percent dividend yield. And this was my dividend search, remember, for dividend stocks that I wanted to trade. Well, another thing I could do, instead of sorting it by dividend yield from highest to lowest, is just use the dividend field to do that. Well, great. I had several stocks that had at least a 2.5% dividend that matched my criteria. How am I going to reduce it if I look for a dividend yield of 3%? I'll change one setting and click Submit these settings. Now remember, we had 69 results first. Wow, that was interesting. Did I change something else by mistake? I don't think I did. Well, that's a pretty narrow margin there, isn't it, John? We had some stocks that paid a dividend of at least 2.5%, but nothing that pays a dividend of at least 3% or greater. Well, that's very telling. Let's look for a percent dividend yield now between. Let's go 2.7%. Let's click Submit. Okay. Hold on. Oh, I think I know what I did. I apologize. That was my mistake. I didn't go back to no lists. Let's go back to 3. I apologize, everyone. First mistake of the night. It's bound to happen. So we'll go back to no lists. All right. So with 3% dividend, I've narrowed it down to 45. I could continue to go higher if I wanted to. I'm just narrowing it down to the ones that pay the higher dividend. Might be missing some opportunities, might not. Another filter that I could increase, just basically, let's go back to 2.5 on the dividend yield. I was looking for stocks that had grown in earnings at least 5% from last year to this year. Well, I could increase that as well. Just go up to 10%. Let's see what we have. Okay, remember, 69 total results to begin with. If I change the earnings per share growth to at least 10, I'm down to 40. This is a more manageable list, but I might want to see other ranges. Also, John, one thing that I could do is sort of play around with the maximum risk. I'm comfortable with a range of 3 to 7.5. Well, what about going a little bit higher? Let's go 3.5 to 6.5. Let's see how that would limit our risk with using the earnings per share growth of greater than 10. Now we're down to 27. That's what I'm looking for. It's usually about 2 dozen to 30 results to go through the list of results that I'm looking for. My approach, John, is when I know I'm looking for, I personally trade the RPM techniques 2 different ways. And this is discussed in the blueprint. You can look for growth or you can look for income. And when I look for a growth position, a growth RPM, which means I'm going to be holding it longer term, expecting more growth, that's when I use the dividend search. If I'm looking for income shorter term, I'm looking for stocks that maybe are lower in price, still have good fundamentals that I would use, but at the same time maybe have a little bit more volatility, a little bit more fluctuation. Yes, that could come back to haunt me if the stock drops when I first open it. But when I go in to create a search, I have in my mind 5 or 6 different criteria that I'm really focusing on. In this case, it was dividend yields. I wanted stocks that had good earnings per share growth, and of course the range that I wanted as well. and maybe even the average stock volume. So when I first say, oh, I've got 80, that's too many, I'm going to focus on those 3 or 4 criteria, bump them up one at a time to further restrict my results. Now John 2, and this is John B. John B wants to know, how do you pick a married put to trade from the list? John, you're a webinar ahead of us. Last week we did the search tool. Today is just the open discussion on the search tool. I'll give you a brief overview, but next week, Tuesday night at 8 p.m., February 8th, that whole hour-long presentation next week is going to be on analyzing and researching the married put from the search tool. This presentation is just designed to be questions on using the search tool functionality to first just identify them. Next week we're going to spend a whole hour to hour and a half going through the different analysis. But John, the steps I go through, of course, is once I have my position, I've also already selected how I'm going to sort it. This particular one is sorting by percentage max risk from lowest to highest. What we're going to discuss next week is we're going to go through the menus in the More Information button. Real quick review. The steps I normally go through is look at the stock chart, and then I'll take a look at the company information. I'm going to then maybe look at the detailed stock and option research. I'm going to look at the search by symbol tool to compare other strikes and risks after I've looked at the stock chart and analyzed my expectations for the stock. And then I'm going to look at the profit and loss chart to run what-if scenarios and analyze that further. Essentially, the SIGA model for the RPM using the More Information menu and other tools on PowerOptions, and the SIGA model for opening the RPM is what we're discussing next week, not really tonight. That More Information button and those processes that I go through when I'm selecting an RPM, and I'm kind of going to focus on the 4 or 5 stocks that I'm tracking right now that I'm considering opening an RPM on. I'm sorry, John, but we're saving that for next week. All right, David. Is this David? I'm sorry, your name got cut off there. Hold on one second. I apologize there. Oops, lost it. Oh, yes, different. This is David. Okay. Does the tool have charts? Yes. Well, in the More Information button for the approach next week, when I go to the charts, I've got the Verizon position listed first. I can go to the 1-year snapshot, but we really want to go to big charts. And next week, I'm not going to talk about how I read a chart. Everyone has their own way of approaching it, David. But I'm going to talk about the filters and the comparisons I use on big charts when I'm looking at it myself, but I'm not going to tell you to use that as a recommendation or suggestion. And what I mean by that, David, is one thing I don't use is slow or fast stochastic. Okay? But that's something that you can use on big charts. Not one of the settings I use. I also don't use what's called the Williams percent R, percent Williams R. I don't use that personally, but that might be something that you would like to use on big charts where you can customize that. All right. Lloyd wants to know, please discuss the Bollinger Band that you mentioned earlier. Okay, well, I don't know if you're familiar with Bollinger Bands from the beginning. The Bollinger Band settings that we have, there are 3 different settings here for the Bollinger Bands. Percent BB20, percent bandwidth, and just the straight Bollinger Bands or previous Bollinger Bands. Bollinger Bands are envelopes based on sort of the 20-day or 50-day moving average that wrap around sort of your stock price. It creates a channel. And some investors feel that if the stock has breached an upper Bollinger Band, that might mean that it's ready to move up in price. If it's been hitting against that upper Bollinger Band, now it's broken through it, that might mean that it's set to continue to gap up above that, to continue up in price and gap up above the Bollinger Band. Others will take that as a contrarian indicator. Look at it and say, it's now hitting off the top or the upper Bollinger Band. My expectation is that it's going to decline now. It's going to start dropping in price since it's hitting the upper Bollinger Band. And then, of course, reverse for the lower sentiments, the lower band that's around it as well. So originally, when we created the Bollinger Band filter on PowerOptions, you could look for the stock close to be above or below the upper 20 band or the lower 20, the upper 50 or the lower 50. And we still left that in there, but we found that that wasn't really the best way to select it. What most investors would look for is if the stock is near the upper Bollinger Band or near the lower Bollinger Band or right in the middle. And that's what the percent BB20 allows us to do. The percent Bollinger Band, the percent BB20, this allows us to screen specifically for stocks that are near the upper Bollinger Band. If the stock chart, the stock tick, I should say, is right at the upper bands, trading right at the upper Bollinger Band, it would have a percent BB of 100. If it's above it, it would have a percent BB of greater than 100. If it's at the lower Bollinger Band, that would be a percent of 0. And if it's at the lower Bollinger Band, that'd be a percent BB of 0. And if it's below that, it would actually be negative. And then, of course, if it's right in the middle, sort of, that would be a Bollinger Band range of 50. All right, now there's the percent bandwidth is a little bit different. If I'm looking for stocks that, if I'm taking it as a direct indicator, and I'm taking the Bollinger Band range as a direct indicator, and I want to see stocks that are near their upper range of their Bollinger Band, think that they might break through that and show a gap up in price, I might use a percent BB20 of greater than of 85 to blank. Now let me go ahead and hit submit and see if we have any. Dividend paying stocks. Oh, good. All right. There we go. Now, I've been discussing the percent Bollinger Bands, but let me show you a couple examples. What I'm going to do is go to the stock charts. I'm going to go to big charts. Let me scroll this over here from my other screen. And what I'm going to do is I'm not going to select any other filters here, but I'm going to go into the indicators, and I'm going to select, oh, I went to the wrong one. There we go. Upper indicators. I'm going to select the Bollinger Bands, okay, from the menus there on big charts. Let's go ahead and draw the chart. And there we go. And let me go to a 6-month chart to view this just a little bit better. All right, how about that? So here's what I'm referring to as the envelopes. So we see we have the upper band and the lower band. At this point, the stock dropped below the lower band, and then it kind of started to spike up. Here it went above. Is my cursor showing up there? Let me circle that with a pen. How about that? So here we had it drop below, and then it kicked back up. But hey, it also dropped below here. And here, it didn't really move up after that. It moved up a little, but it didn't really take off. So the third one, when it dropped below, we see the rise, and it went above. But notice what didn't happen. It continued to move up, but it didn't break above that band. And, of course, there must have been earnings the other day, and that's what caused the spike. And now it's above that upper Bollinger Bands. All right? So this stock has been moving up at a pretty decent clip over the past 2 or 3 months. Now, let me clear up that drawing very quickly. One other thing I wanted to point out, the second filter, and we'll go back to it on the search screen, is called the percent bandwidth. And what that refers to is the range between the bands at a given time. So this is a very wide bandwidth. This is related to the volatility of the stock. The more the volatility, the higher the range. Here it was kind of in a channel. Right? We're kind of in a channel here on the Bollinger Bands. But when we had this gap up like we did yesterday, or a couple days ago, what do we notice? Just in this section here in the last 3 days, from here over, we saw that bandwidth spike up. It widened, and that means there's more volatility on the stock and on the options. Okay? So that's just a brief review of the Bollinger Band settings and how they're used. Again, why am I not saying, oh, you want to do this with the married put or you don't want to do this? The reason why is because some investors will use this as a direct indicator, where a bullish sentiment means that the stock is near the upper Bollinger Band. Others will use that as a contrarian indicator. You have to kind of decide which one you feel is best. Now, while we're on this, very quickly, I'm going to navigate away from my search filter here. Let me save this so we can come back to it. Very quickly, I'm just going to save this search here, so when I come back to the screen, it's going to be available. What I was going to show you, Lloyd, is what you want to do on your PowerOptions account. Click on the long call or the long put tab to go to the long call or the long put home menu. And as you scroll down there into the Learning Center of the long call or long put, that's where the article is for the Bollinger Bands for long options, and the same thoughts would apply to using the Bollinger Bands for the married put screen. Okay? All right. All right, Dave wants to know, aren't you interested in where IV for the option is compared to the underlying historical volatility of the stock? Dave's a buyer of options when IV is in the bottom half of the range. I guess he's looking for more undervalued options. Okay? And Dave, honestly, I'm not. And I don't mean to say that as in you should never use that when you're trading radioactively. The whole point of this search tool, and remember what we talked about, the whole point of the technique is to use positions that use stock selection processes that you're already familiar with to overlay on that. Now, let me go back for one moment to the default radioactive filters. I'm going to make a couple changes there, but I'm going to go back to the default radioactive screen. At the same time, I'm going to go back into the See More or Less Columns menu to pull up the configuration page, and I'm going to reset to the default settings for the time being. And I'm going to click Save and Return. All right, so that just takes us back to the basic view. Now, in the last discussion, Dave, when we discussed the fields for implied volatility, percent implied volatility range, IV over HV and IV over SIV, these are filters that you can use. When I usually do a search, as we talked last week, my restriction for the maximum risk is to be between 3.5 and 7%. Sometimes it's really between 4 and 7%. By using this field and the common stock filters I use, or if I use the IBD 50 and canceling list, I'm essentially already taking into account the delta and implied volatility. If the stat, and I know this isn't part of your question, but this goes into your question. If the implied volatility is too high, the option is naturally going to be overpriced, as you well know. And what that means is it wouldn't have fit this criteria for the percentage maximum risk anyway. If it's overpriced, if it has a high volatility for those or implied volatility for those far out options, the maximum risk would be above 7%. It'd be near 10%, 11%. I'm already filtering that out. Plus, I know that looking for particular stocks that have a risk on the married put between 3.5 and 7% with the IBD 50 and cancel list or the criteria I use, the delta is already restricted. The delta is probably going to be between a range of maybe negative 0.55 to maybe negative 0.8 at the high end. It's not going to be higher than that because I'm not allowing the risk to go lower than 3.5, and it typically won't really reach negative 0.55. Now, IV over HV, could I use that in my screen? Yes, I could. But for me, and I know what you're looking for, you're kind of using that to be an overvalued, undervalued option. And you're looking for options that have a lower implied volatility to historical volatility range, so you're not paying too much for the option. If it matches my risk, though, I'm not concerned. If my risk is between 3.5 to 7%, I'm okay. And if it has a wide bid-ask spread, I'll see that when I go to enter my trade, and I'll put in a limit order for the put option. Now, from last week's presentation, the one thing that I do focus on that got me trapped 4 or 5 months ago is I am now using in my personal searches a filter for the percent implied volatility range. Now, before I select that, I need to, of course, back up my statements. And what I'm going to do is scroll up to the top. We're going to go back into the See More or Less Columns field. And what I want to select is delta, implied volatility, the static implied volatility of my far out option, IV over HV. I'm going to even use IV over SIV as well. All right, so let's take a look at those in the data columns. Now remember, this is just the default search for the IBD 50 and cancel-in lists. Now, I do see some ranges here, Dave. I have some that are above 1.11, meaning this particular option, or 1.13. Let's look at the second one on Stanley Works. That means the implied volatility is 13% over the oh, that's SIV. I apologize. Let's go to the third one on Rovi. Let me get my column straight. There we go. Here's IV over HV. So I have one here that's 1.15 and one that's 1.18. Here's a big one, 1.22. Now, if they're still in the risk level that I want, and as I do my further research and analysis, I feel that these are good companies, I'm okay with this IV over HV range personally. I'm not saying you have to be. You can definitely filter for that if you want to. But personally for me, this is not too large of a range. It looks like the lowest one on the first page is 0.90. So that tells me that the option is technically, the implied volatility is 10% lower than the stock's historical volatility. And the highest one is 1.22. So that's not too wide of a range, 20 above, 10 below. I'm still within that range. As I mentioned with my deltas, on that first page there, I don't see anything. Oh, I did have one. There's one here on this stock FMC Tex, which has a delta of negative 0.53. And the highest delta I have, or lowest, if we look at the negative, is negative 0.72. So I'm well within that range of the delta I would use, and the implied volatility to HV ranges aren't too restricted. Now, keeping that data column, let me go back to, not the Bollinger Band search, but I'm going to go to the dividend stocks from January 25th. And I just want to see the ranges there. Now, there are some that look out of whack. On the dividend-paying stocks, that's interesting. I haven't really seen that before. I'm not using all the criteria I normally use. That's why. Normally, when I run the search for my dividend-paying stocks, I have things such as Kraft. I have things such as Heinz Corporation, Johnson & Johnson. And those really have that low range, and my delta is restricted into there as well. But dividend-paying stocks, the trick with the dividend-paying stocks, always to remember, is that, they'll always have a low 52-week volatility. They tend to move very slowly in that range, Dave. So I don't use them personally. You can absolutely use them. Again, the one thing that I do use now, as I mentioned, is the percent implied volatility range. What that shows me is where is the option's implied volatility now compared to where it has been over the life of the option. My typical restriction is I only look for put options that have a percent implied volatility range of maybe less than 70 or maybe less than 75. And the reason for that, of course, is volatility collapse. It hurt me on a position in RPM. A couple months ago, I opened on EPB, El Paso Pipeline. I actually entered it when the percent implied volatility range was at 85. I didn't pay attention to it. Volatility collapsed, and stock didn't move, and I had a $1.50 drop. And so that had nothing to do with the IV over HV range, by the way. It was just the percent implied volatility range of the option itself. It was still well below, actually, the historical volatility for the stock. But just that little crush of implied volatility on the option caused a $1.50 loss in the put, and the stock hadn't moved. Now, I was still only risking, the most I could have lost in the position was 5.5%. When that happened, I went from having a loss of 1% to about 3%. So I was still comfortable in the range, and I was still collecting a dividend, but I didn't want to have that happen. All right, so again, I'm just going to go back in the see more or less columns field quickly, and I want to select the percent implied volatility range there. All right, fantastic. Let me click Save and Return. Let's go back to square one. All right, there we go. So now I have the percent implied volatility range there as well. All right, very quick, John F. wanted to know, are these all recorded for viewing later? Yes, very quickly. Let me go to the screen. I'm going to show everyone on PowerOptions where this is. So you go to your PowerOptions account. Let's go to Home. We're going to go back to that search in just a minute, so we're not even close to being done with the questions yet. Go to Learning Center from the main Home menu and select Webinars from the Learning Center menu. This will take you to the webinar page. You have the upcoming webinars on the left, the previously recorded webinars on the right. These series are all going to be in the PowerOptions for RadioActive Trades archive. We created its own header. So let's just click on the header there. And we've got Part 1, PowerOptions Search for RadioActive Trades. That was last week. This one will be archived there tomorrow, the open discussion on using the PowerOptions search tool. And as we continue to go through the series, those will appear here on the webinars page in the PowerOptions for RadioActive Trades archive. Of course, you also have Kurt's archives there and general PowerOptions archives as well. This whole series will be recorded, John, and available for you in that menu. All right, let's go back to the search tool there. Is average stock, Gordon wanted to know, is the average stock volume of 750 measured in thousands? I did take it off my data field there, but yes, the average stock volume is measured in thousands. So if I only wanted to look for stocks that averaged 1 million shares per day traded over the last 90 days, I'm going to put in a field of 1,000. Okay, and we'll just run that search now. We'll filter our list down. Of course, DuPont's there, trades a lot, Waste Management, Cisco, the other Cisco, not the real Cisco. I don't know which one is the real Cisco, but not the big Cisco that you see commercials for. And then, of course, you can always select the see more or less column. So, yes, that field is measured in thousands, as is the market cap field. Okay. John asked an interesting question. John F. again asked an interesting question that I'm going to answer, but I don't really know if I have a great answer for. John F. wants to know, do you analyze the overall market first to decide if you want to open a position? Short answer, yes. Long answer, not really. Okay. Now, for the past couple of weeks during these presentations, you've heard me say that I'm only in 2 RPMs now, but typically roughly 50 to 60% of my investment capital is in the radioactive profit machines. Why do I only have 2 positions now? I personally have a rule myself that I developed over the last few years of trading that after December expiration, I typically don't open new positions till the new year, until maybe the first week of January or the second week of January. The reason why is because after December expiration, before the holidays, the big money, the institutions are those guys are going on vacation. They have a lot more vacation time and a lot more money than I do, so they're going on 2 or 3 week vacations. Sure, there are some opportunities to trade, and I've done short positions during that time frame, that lull, let's say between December expiration, Christmas, and then New Year's, as everyone's on vacation and focusing on the holidays. Sometimes that's a good time to sell premium because it decays more rapidly because there's not a lot of activity. I've done that in the past. But typically during that time frame, I don't open positions. This year I was still skeptical of some things. So I was waiting to see I was actually waiting until after January expiration before I looked to open new positions. But John, there is a rule. Now, I trade other positions. You know this. I also do standard collars. I'll occasionally do credit spreads. If my sentiment short term is it's more of a bearish market than a bullish market, then I'm going to be using bear call credit spreads. For example, I might not be looking to open RPMs at that time. I might be looking to do some bear call credit spreads. I might also be looking, if I feel it's sort of a stagnant to falling market, I might choose to do some naked puts or a calendar put spread with the hope of maybe getting the stock put to me at a lower price because of the premium I received, and then treating it as an RPM. So I do analyze the market beforehand before looking to do a trade, but really it's more, I don't want to say an art, but it's more of a sentiment rather than a lot of fundamental and technical research. When I feel the market's turning, or market's going in the direction I want, or I'm feeling confident in the way the market's going, that's when I'll look to do that. Okay, Richard asked a question. Why do you use 5 months on the protective put versus a put option expiration closer in time? Richard, I don't know if you have the blueprint, but to take advantage of one of the 3 core principles of the blueprint, the radioactive decay line, if I buy options short term, it's going to have a much higher annualized cost. All right, so we're going at least 5 months out in time because the radioactive decay line shows us that the rapid decay of time value occurs in the last 60 to 45 days of the option. So by going minimum 150 days out, I can trade the position for maybe almost 3 or 4 months before seeing any rapid time decay. My risk, the risk that I'm taking about is just, I apologize, is the risk that I'm taking is just the time value. So if I'm buying shorter term, if I bought protective positions month by month by month, I'd pay more over a 6-month period than if I just bought the 6-month out option right now. One of the core principles in the blueprint, that radioactive decay line, what it shows us, and this is true of all options, when I'm buying options, earlier David mentioned that he buys options and he focuses on an IV over HV. I bet you Dave typically is buying options that are at least 4 or 5 months out in time. And the reason why is because, number one, it gives you more time for the stock to move in your direction, and number two, the option that's 4 or 5 months out in time is not 5 times the cost of the near-term option. It works just the same way as insurance, let's say, for your car. Okay, brief review. Let's say that, because we discussed this a little bit last week, but let's say that your car insurance policy is $100 per month. If you pay month by month over the course of the year, you're going to pay $1,200. We decide to go to your insurance company and you tell them, hey, what if I paid a lump sum and I paid twice over the course of the year and paid 6 months each? Or I'm sorry, I made a payment every 6 months. They'll say, okay, we'll give you a little break. If you give us a lump sum payment every 6 months, we'll only charge you $550. So then your total over the course of the 12 months would only be $1,100. You're getting a break for paying in a lump sum or buying 6 months at a time. And then, of course, if you went in and told them, I'd like to pay a year up front, they'll say, okay, we'll give you another break. We'll only charge you $1,000 if you pay it up front, which is a 20% discount. Options are priced the same way. So when I'm buying an option, if I'm buying 6 months out in time, I'm not paying 6 times the cost. If I traded the same position and bought, let's say, the in-the-money put option month by month by month by month, number one, I don't have a lot of time for the stock to move in my direction, and number two, after 6 months, I'm going to end up paying a much higher premium than if I just bought the 5-month out or 6-month out put up front. All right, so that's the reason why. That's discussed in the blueprint there, Richard. That's one of the 3 core principles of why we're going at least 5 days out in time. All right, Chuck wants to know, in every strategy I'm looking for high probability trades. Can you talk about why these low risk and less than 20% ITM puts are why this is the area to focus on? Okay, well, sort of an interesting scenario. I don't know how exactly I know how I want to answer this question, and I don't know what your performance been, but in the past 8 years of being the director of education here, Chuck, I've talked to customers who trade credit spreads for a period of time. They're only looking for credit spreads, bear calls or bull puts, that have at least an 80 or 85% probability. I want that high probability of success. I'm looking for in-the-money covered calls. I'm going to buy a stock, sell a call below the the current stock price, going in the money, looking for a small return of maybe 1.5 to 1%. Getting a high downside protection, and having a 65 or 70% probability that I'm going to get assigned. The problem with the credit spreads is that over the long term, as I've seen, and this is my experience, if you're a better stock picker than I am, you might not run into this problem. But if I'm looking for credit spreads that have an 85 or 90% probability, those credit spreads have to be deep out of the money, meaning that I might be looking on a 5-point spread, I might be looking to make 50 cents. Yeah, I have an 85 or 90% probability of being successful, but I'm looking to make 50 cents while risking 450. I've got a high probability of success, but if one position goes against me, it's going to wipe out 9 previous trades. We're not focusing on return here. We're focusing on limiting risk, because most of those other strategies that people peddle, I know you've all seen these. You've seen these ads. You can make 1,000% on long calls in 2-week periods. Watch what we do. You can make 6% per month on covered calls trading with a high probability of success. But those leveraged positions, over time, will end up as a sorting machine. With the leverage spreads, the credit spreads and the debit spreads, you have one trade go against you, it'll wipe out 5 to 10 of your previous trades. You can go back to square one. Covered calls, we've always talked about this, how it can, over the long period of time, it'll work out to be a sorting machine. The winners that might move up 5, 10, 15% get called away from you from a 3% gain. The losers end up staying with you. So I have 5 stocks in my portfolio that are down 15 to 20% from where I bought them, and the other 5 stocks I had got called away for a 3% gain, even though they moved up 10%. Chuck, if I'm not, correct me if I'm wrong, I thought you were looking at high probability naked puts that were far out in time. That has the same risk-reward profile as a covered call. And I'm sorry if I mistook you for another client. I talk to about 50 people a day, so sometimes I get confused there. But our focus is on the risk. And, you know, Kurt spent 3 years, or 2.5 to 3 years, developing this technique to find out where were the ones that best matched this limited risk, this single-digit risk, and what are the benefits of it? The benefits are, if I'm opening positions that have an unlimited upside profit potential when I open them, I'm not capping my gain, and I have a limited risk, I can actually be wrong more often than I'm right and still make money. Now, that's not my goal. I personally try to be right more often than I'm wrong still. But when I'm wrong, if I'm only losing 4% and I'm guaranteed that exit, but when I'm right, you know, the stock moves up, I can earn 7, 8, or 9%, I'll play that game all day long. And plus, with credit spreads, I found that here in the office, even though I have my screen up the entire time, I just wasn't watching my trades as actively as I needed to when trading iron condors or bear call credit spreads, because I was doing webinars and other searches. All right, George wrote in, if your search reveals only 8 to 10 stocks, do you like to select the stock from this list, or do you reduce the criteria and see more stocks? 8 to 10 is okay. But I'll go through that process, George. Remember, I selected a Bollinger Band screen. For example, we ran that Bollinger Band search. Let me select that default back from the search menu. All right? We've got 9 stocks here. Actually, I do have 9 stocks. Sometimes I'll have duplicates. I'll have different strikes in the same stock. Okay? Well, I'll start going through the process that we're going to discuss next week. I'll take a look at the stock chart, the company information. Now, the first step, I will tell you, I look at big charts. I analyze big charts based on what I like to use. If I don't like the first stock, I don't like the chart pattern or what I'm looking for, I'm essentially done with that first stock. I'm not going to spend any more time on it. I'm going to move to the second one. If I went through all 9 lists, all 9 stocks in this particular list, if this were the filters I was using, and I couldn't get past the stock chart list, I might not make a trade today. Why force myself into a position that I'm not comfortable with? I don't want to trade. I'll run a screen tomorrow or the next day, see if something comes up. I'm not going to try to rush into a trade just because today is the day that I have to use the trade. John wanted to know, you mentioned that you use a dividend search for growth, and what do you use for the income stocks? Well, it depends on my personal preference. I don't want to give you recommendations or suggestions. Normally what I might look for is stocks with a little bit more volatility, maybe a historical volatility of, say, greater than 0.25 or greater than 3. I might reduce some of my fundamental criteria, the earnings per share growth and the price to earnings. Naturally, I won't look for a dividend. I'll still want to look for high volume stocks, and I might look for a lower price range. Let's see, what else might I use? Beta. Sometimes I'll use beta too, John. I'll look for stocks that have a beta that show more fluctuation than the S&P 500. So those are some of the filters I might use if I'm looking for income trading stocks. All right, David wants to know, what is the highest IV on the put that is okay to trade? Actually, David, there is no real way to answer that question. Again, as I answered before, when I'm limiting these screens to this risk of 3.5 to 6.5%, the implied volatility of the option by itself is usually going to be in a limited range. It's not going to be too high. If it was too high, if it was above maybe 0.6 or 0.7, the percentage at risk would probably be too high, so it wouldn't have matched anyway. That is more of a personal preference. It really is. And, excuse me, by the way, it's also related to the stock. What I mean by that, and when I'm let me go back one step. If I'm doing that dividend search, David, most of my stocks are going to be in this implied volatility range, this lower implied volatility range that we're seeing here, ranges of maybe 0.35, 0.41, 0.26, very reasonable ranges. By the way, one thing that Kurt and Ernie have suggested recently in the past year or so, and is now in the default radioactive screen, is for the historical volatility in the stock, they recommend looking for stocks that have a historical volatility of greater than 0.25 or 25%, because you want to see some movement. When you trade the dividend-paying stocks, you have to lower that a little bit, because some of the dividend-paying stocks have closer to a almost like an index type of volatility of 0.8 or 0.9. Personally, David, I want to say that I'd never go above, I know what I'll say. I'm going to say that I would never trade an option with an implied volatility more than 2 times the average implied volatility of the market. Well, that's a loaded statement. How would you find that? Well, again, let's go back up. I'm going to go into the Learning Center again. I'm going to go to the Home tab, and I'm going to go to Learning Center. And from the Learning Center menu, I'm going to go into Market Activity, second from the bottom here. And in the Market Activity selection, I'm going to go into Optionable Stock Statistics. This gives me a chart of the high, the max, the min, and the average of some of the criteria in the search tool. So this is just something you can use as a gauge. And, oh, there it is, the implied volatility. The average implied volatility right now across the market is 0.59. All options, the average is about 0.59. So to me, I'd say definitely I'd never look at an implied volatility over 1. But I know, just by the filters that I'm using, David, keeping that risk less than 7 or 7.5%, even less than 8%, I'm probably not going to see any implied volatilities greater than 0.6 or 0.7 to begin with. So there's no real high range. And honestly, if I saw an option that had an implied volatility of, let's say, 0.75, but the risk, for whatever reason, was still below 7%, and it was a stock I liked, I'm focusing on the maximum risk, not the implied volatility. All right? But this is just where you can look at it. So, for example, the average stock volatility is 0.33 right now. And why is there such a difference between the... Oh, this kind of does go back to the other question on IV over HV. They're all stocks that will, of course, have an implied volatility lower than the historical volatility, but it's it's always something you might want to keep in mind that right now across the market, the average 50-day volatility of the stock and even the average 250-day volatility of the stock is lower than the average implied volatility, and that's because we just passed through, and we are still passing through the last remnants of an earnings season. So the options are increased in implied volatility because the earnings season, even though the stocks might not be fluctuating as much in price. All right, so let's go back to the search screen there. Hope that answers your question there, David. All right, now I'm going to go back to the radioactive screen to answer the next question. Let me go back to the dividend search actually to see if this is what, yes it is, great, fantastic. Ron wanted to know, why are there 3 Cisco Corps and a couple of Verizon Wirelesses? Well, you'll see this from time to time, and we're going to discuss this a little bit later on in the future. Next week. I'm sorry, next week. We're going to go more in depth into this next week. But what Ron, of course, was referring to is I have a Verizon position here. Stock's at 36.16. I can buy the July 39 put, and that gives me a maximum risk of 3.6%. Wait. I've got the July 38 put here as well with a 4.2% at risk. And further down, we have the whole block here of those Cisco positions, and these aren't very different. Well, that's very interesting, isn't it? I've got an August 30 put with a maximum risk of 4.7%. I've got a January 2012 35 put with a risk of 4.7% and a January 32.5 put of 4.8%. The reason why I'm seeing multiple ones is this stock, Cisco, obviously matches my stock criteria, but these different strike prices, an August 30 to January 2012 35 and the 32.5, still match my risk level. Let's focus on the Verizon position first. I do have 3 July series in here and an October. There's an October as well. But one of the steps that I use when I'm analyzing the search results is after I've looked at the stock chart from the More Information menu, and I've looked at the company information, the news and the headlines, and maybe looked at some of the detailed research for the stock or the option, I'm then going to go to the Search by Symbol tool. This is another tool that you could access directly when you go into the Married Put menu instead of going into the search screen. Now the Search by Symbol tool allows me to compare all of the different strike prices, and of course with these types of stocks that have single-digit strikes or single strike differences, there's going to be multiple ones. But it shows me the risk level and the different strikes. Now why is this important? Now just based on my risk of let's say 3.5 to 7%. We have 4 Verizon July positions that match my criteria. Okay, the 36, the 37, the 38, and the 39. They all match my maximum risk. They all match my open interest. Naturally, it's Verizon, so the stock matches all of my criteria. Now, in the decision process, Ron, after I've looked at the stock chart, that's going to give me an idea of where I think the stock's going to be trading in the next 30 to 45 days. Based on that, if I'm more confident that I like Verizon, but I think Verizon's more likely to be trading at $36 or $37 per share in the next 30 to 60 days, I might take the higher risk of 5% or 6.2%. Because as the blueprint discusses, and as I mentioned during these webinars, to me, the best time to apply one of the 10 income methods or any one of the bullish income methods of the 10 income methods in the blueprint is when the stock's trading close, right at or just near the put strike price. So, does the deeper in the money put offer me a lower risk? Absolutely. But if I'm more confident that the stock might be trading at 36 or 37 in the next 30 to 45, maybe 60 days, I might be comfortable taking the higher risk in that case to look to apply an income method sooner on the position. Okay? So that's more of a personal preference after you do your research and analysis, but that's why those multiple strikes are in there. It's just as if you did a covered call search on Apple and you wanted to see all the covered calls in February that offered at least a 2% downside protection, a 2% return if unchanged if the stock stays at the same price, and at least a 3% return if assigned. Well, you might have 3 strikes in February that match that criteria. Okay? You might have the 350, I forget where Apple is, I apologize, but you might have the 350 strike, the 340 put, and so much there. Okay, so that's the key. That's why there are different strikes there, and we'll talk about that more next week when we go into analyzing the RPM. All right, David wants to know, have you developed a married put strategy for the weekly options? Actually, David, in my opinion, it's no. I've been doing research on this for the past couple months. I think it's the same process. I've tried to say, okay, let me use the weekly stocks, which are limited to begin with, so you only have 40, really less than that because you can't trade the indexes in this fashion. So you've got maybe 36, 37 positions, underlying securities that you could trade. And I said to myself, okay, if I'm able to trade weekly options, wouldn't I shorten the put strike price to only 3 months out or 2 months out and then look to apply the income methods faster? Well, there's something so ridiculously wrong with that statement, I didn't even realize it when I said it. I can't dictate what the stock's going to do even if I'm trading a stock with the weekly options. The stock still has to move in my desired direction in order to apply the income methods even with a weekly option. So I found it's actually better to keep the one, believe it or not, it's actually been better so far to keep using a put that's 150 days or more out in time and then maybe try to use the weekly options after the stock moves up. But we're never going to do a position, with the RPM techniques, you know this, when you buy the stock and you buy the put, you don't do an income method right away. You wait for the stock to move before looking to apply one of those income methods. And you might pass 1 weekly cycle or 2 weekly cycles before you have an opportunity to apply one of those 10 income methods. Okay, John says, buy the blueprint. It's great. Thanks, John. Okay, Shiva asks, can I start with a less than 10K account for an RPM? Hold on one second. Ooh, okay, good. I just want to see how many questions we had left because we're past 10 o'clock. Good. Shiva, I don't want to give any direct advice on how you should invest your capital. This is a protective position, so if you're only investing with 10K, I would definitely advise you against trying to do the leverage positions when you start out. I originally started with only devoting about $8,000 when I started trading RPMs, and that only put me in 2 positions. Kurt's first RPM that he opened on Amazon, he only had $2,500 after he lost all his money trading covered calls. He started trading RadioActively after he built that back up and only started with $2,500. Yes, you can do the RPMs in a lower sized account. It just means you're going to be trading fewer trades and potentially not as many shares of a particular stock. Okay? Right now I'm trading personally with about 33,000. David, what about ETFs? Yes, we've discussed this before during the webinars. We discussed it last week about how to screen for ETFs. Let me just do that very briefly right here. Start off with the same processes. I'll go into the search menu and we'll hit clear these settings. We're going to empty everything out. First step, what am I going to do? Put in the fields for the 3 core principles. 150 days, and I'll just minimize it to 500. Not going to allow the put to be more than 20% in the money. And look for my net risk of 3.5 again to 7.5%, roughly. Personal preference. You might want to go lower on your lower range or higher on your upper range. Open interest, I'll go ahead and put in 10. And of course my restriction for total net debit or stock price, we'll negate that for now. I'll go to 150 instead of 55. That way we'll see some of the broad-based ETFs in there. Now I'm not going to put in naturally anything for earnings per share growth, price to earnings, because they're not there. Now, down at the bottom, from the recommended list, I'll select indexes, ETFs, and holders. Just do that, hit submit these settings. And to further answer your questions, David, if you look at the Fish and track record, Kurt has traded DIA, SPY, and the Cube successfully with the radioactive trading technique. So I have 270 total results in my ETFs. But I know right away that I'm going to filter some of these out. For example, for me personally, I've got some of the ultras. I bet you some of the, yep, there's one, the ultra shorts. I don't want to see those. I don't want to see the 2 times or 3 times ETFs personally. You can select to view those. So what I'm going to do is go back down to the list. I'm going to remove stock lists, and I'm going to remove my leveraged ETFs. Okay? And of course, I could further filter this if I wanted to look for ETFs that had a dividend, had a different stock price range, had a lower maximum risk range, for example. You can play with that as you want. But yeah, it's been done in the past, and some investors will use it for the ETFs as well. This is a question, Mary, that's a great question. I'll be directly honest with you. 2 years ago, I would have answered this question and said, yes, absolutely. Recently, I don't because of something different. And I'm being cryptic to everyone, but now I'm going to clear that up. Mary asked a question that I think has been a lot in your been on a lot of investors' minds. A lot of people online have probably thought about this question. A lot of you online, who may have just read the sketch. If you don't own the blueprint, if you just read the sketch there and you saw, okay, I see what they're doing. I'm a covered calls trader. These guys are going ahead and buying a Mary put for protection. They're buying an in-the-money one. Hey, that's unique. I see how it's working. They're limiting risk to single digits. If I opened a position, I'd sell a call right away. Well, that's a big no-no, and we'll talk about that next week a little bit more, why that's a big no-no, why you don't want to do that, why you want to wait for the stock to move. What Mary asked is that, oh good, I got a Sara Lee position here that almost does exactly what I want it to. What Mary wanted to know is before you enter an RPM, do you look at the call premium to see if it's got enough premium on the call before entering the RPM? Dead honest with you, 2 years ago I would have answered that yes. Right now, I say no. Now, first off though, how would I want to do that and what would I be looking for? Let's take the Sara Lee example, the first Sara Lee example here. Stock's a low price stock at $16.99. We're looking at a 2012, a year output, the January 20 strike put for about $4 for $3.90. Total investment is $20.89, and the maximum risk is 4.3%. This is almost the exact same price I had on my Office Max position 2 years ago. Now, I break that down, and I say my maximum risk is 89 cents. Worst case scenario, I'm holding Sara Lee for 353 days, almost a year out in time, and I've got to make up minimum of 89 cents. Well, I better make sure the near-term call premium, maybe the at or slightly out of the money call premium, would help me get to that. By the way, this is something I do with calendar spreads when I trade the diagonal spreads. But what I would do here is I would link to the option chain, and it linked to the 5-strike put chain because I was originally on a put search, a search that uses puts, but now I'll go to the call premium. Well, I'm selling the 20-strike call, so I know by rule I'm not going to sell a call using income method number 1, Mary, unless the stock is trading at or near the put strike price. Well, the stock's at $16.99, and I see that the 18 strike, 1 strike out of the money, so if I waited for the stock to go up to 19 before selling the 20 call, I can say, well, maybe the 17-day out or even the 1-month out put, if I went to March, might be near 20. Here it's 10 to 15 cents. It might be near 20 to 25 cents for 45 days out. So let's do that. Let's go to March. February is a little bit too close for my tastes. Now, what am I doing here? I am projecting. I am massively projecting. What I mean by that is I'm assuming that, hey, if the stock moved up to 18 or 19, let's say $19 per share, the 20 strike, which is equal to my put strike price, this is 1 strike out of the money, would be about equal to the 1 strike out of the money call right now. That's a bit of a projection. That's a little bit of a leap, for lack of a better term. But I see here that the 1 strike out of the money, 17 is right at the money. The 1 strike out of the money is a 20 to 25 cent premium, and it's 45 days out. So if we have 4 times 45, we're a little bit under 200 days. So I could say, okay, I collect 20 cents for four series and 200 days. So that would give me 80 cents. I'm close to paying that off using the at-the-money calls. Now, that's the process you would go to do it. The reason why I don't do that anymore, Mary, is you've heard me in these presentations. Income method number 1, just selling the call against the RPM, is the last choice I look to use. That's the last income method I try to use if at all possible. I had a great opportunity with Silver Wheaton. You've seen that in the past with the presentations when I opened Silver Wheaton on May 21st. The stock moved up, and I was able to bulletproof it in 30 days by selling the at-the-money call for $1.48. My total risk beginning was for $1.50. That one worked out well. But as a general rule for myself personally, especially if I'm doing those growth positions, the dividend stocks, income method number 1 is the last thing I look to do. So I personally don't look at the call premium anymore when I'm opening the RPM. All right, let's see here. Now, Chuck had to leave. I'm sorry I missed you, Chuck. Chuck had to leave early, so he'll see us next Tuesday night. Shiva asked, Mike, there are some other CD sets from PowerOptions other than the blueprint. What do they teach? Sorry, Shiva, I don't know. We don't have any other CD products that we sell that aren't related to radioactive trading. If I go to the Power Store here, there's the Covered Call course, which is a book, DVD, and a workbook that was written by Ernie and Greg Zerener that just discusses covered calls. the blueprint. But all of these CDs, income methods from the beginning, the advanced income methods, profit with puts, Money Nets webinar, combining income methods, foundations of radioactive trading, those are all related to radioactive trading in the blueprint. They have nothing related to power options or the other strategies. Now we have the Iron Condor book, the Naked Put book, and the Protective Option Strategies that discuss married puts and collars. Those are related to other strategies, as the titles project. But no, the CDs that are there only discuss the radioactive trading technique. There's a base CD that you can sign up for free, which has some of the archived webinars for radioactive trading on it. And we have one on Power Options. It's a free CD that has some of our archived webinars on it, some of the older ones. But no, all of the CDs are all related to radioactive trading, Shiva. David wants to know, can you explain the process of getting out of an RPM when the stock has a big drop over a month? Well, we'll talk about that, of course, more in depth in the presentation on the 23rd when we're doing the, the 16th when we're doing the portfolio tools, which is also going to be management. There's essentially two ways to look at it, David. It depends on, number one, how severe the drop is. What I mean by that, if there is a large enough drop where the put delta spiked up so quickly that it's almost trading at parity, you can just exercise the put with your broker. You should be able to do that. Exercise the put, sell the stock at your put strike price. If in the first month the stock dropped, let's say, 10 or 15%, and I still have 6 months left on my put option, if I still have a reasonable amount of time value left on the put, I'm not going to exercise the put because then I'm denying myself the time premium. I'd look to sell to close the put and sell to close the stock. Or just a simple math example. Let's say you and I, David, bought a stock at 50, and we bought, let's say, a 55 put for $7. Okay, so our total investment is $57. Our maximum risk is $2. Let's say right after we open the position, the stock drops down to, I don't know, let's keep it simple, $45 per share. It's about a 10% drop, but we all of a sudden decide we don't like this stock anymore. It's not doing what we wanted. Stock's now trading at 55, and let's say, stock is now trading at 45. And our 55 put is now trading, let's say, for $11. I've got $10 of intrinsic value and $1 of time value. If I just exercise my put, I only get $55 back. However, if I sold to close the put for 11 and sold to close my stock for 45, we now get $56 back, so I only lost $1 total on the RPM. Okay? So it really, if you have time value, a reasonable amount of time value left in the position, what you would look to do is sell to close the put and sell to close the stock. And then, but if it's trading right at parity, you could just exercise the put and potentially save yourself a commission cost. And of course, if the stock dropped only 5 or 6% in the first month and I think it's going to come back, hey, I'm going to look at income method number 6 and income method number 9 to adjust the position. Shiva says the money nets. Shiva, the money net CD is income method number 5 and income method number 6 from the blueprint. That's what the money nets refer to. That's Kurt's term for income method number 5 and income method number 6. Okay? So all those CDs are there. Oh, David, remind me to send you an email after this. I love this question. I'm glad David asked it. Can I run an example now? I'm pretty sure I can. This is not a stupid question, David. This is a question I get all the time. David wants to know, can I replace the RPM technique by using a deep in-the-money call option combined with the in-the-money put? You can. I think it's a bad idea. I've got an email I'll send you later on, David. I've done at least 5 examples of this for customers in the past. The most recent one was on an IWM example. Customer wanted to know, what was his combination? Was it? I think it was an 80 strike put. Let's take a look at it, shall we? Let's go into the custom spread tool and let's build an example. Okay? And I will send you this email, David, after the webinar where I've done the write-ups on comparing these two. Okay? Let's take a look at IWM. That's the Russell 2000 ETF. All right? Let me go ahead and view options. Now, building a married put. Add stock. Let's just buy 100 shares at the current price of $79.45. It couldn't have been the 80. Oh, it was something that was too... This example that the customer used, the put was too deep in the money for me. He was using a 110 put combined with a 30 strike call. Well, I'm going to use the same example just to keep things straight. But when I looked at it, I said, no, that's way more than 20% in the money. In fact, I want to do that. I want to use the 20% in the money put option far out in time. We're going to use January 2012 here. We're going to go a year out. Okay? Let me use the 90 strike put on the stock. Let's see what that would look like. Okay, so I'm using the January 2012 90 strike put. And I'm going to rush through this quickly because I do have some other questions. I'm going to send you that email, David. I'm going to send you 2 emails. I did one several months ago on a comparison on IBM, comparing what we call the in-the-money long strangle versus the RPM, and this one is on IWM. All right, so I'm going to buy one put. Let's see what that looked like, the 90 strike put. Does this match my risk level? Let's keep it fair. Yeah, it does. All right. So I've got an investment of $94.30. It's my total investment, $9,430. I have the 90 strike put, so my maximum risk is $430 or 4.6%. Static break even at expiration. Remember, I hold it all the way for 1 year, make no adjustments. My break even is the net debit, $94.30. Now, I know you probably wouldn't, you might not look at the same one. Everyone has a different way. But what the last customer I talked to wanted to evaluate this was using a call, replacing the stock with an in-the-money call in the same put, but a call that was so deep in the money that the delta was just as close to 1. You do run into a small problem with doing that, by the way. If you look for that option that is so deep in the money, this one, by the way, was over 50% in the money, you do have maybe some open interest there, but you don't have a lot of volume. There's a wide bid-ask spread. It's unlikely that you'll get filled, but we're going to use the example. Okay, so remember our prices. Investment of $9,430. Total at risk, $430, and a percentage at risk of 4.6%. Now we're going to compare this with the January 2012 30 call. About as deep in the money you can go. The delta is pretty much close to 1. I know some of you might only go to the 70 range or the 60 range, but that's okay. I'm just going to use this as an example for now. This was the example that was used, and I can look at one of the other ones too very quickly. All right, so now we're replacing the stock with the 30 call. Let's go ahead and hit submit. So I'm putting $49.74 into the call, $14.85 for the put, and we're pretty close. I now have a $6,459 investment, and I'm risking $459 on the position. This is an in-the-money strangle. That's what it's referred to, which is a total risk of 7.1%. And you still have unlimited potential on the upside. Now this looks like a good trade, but of course the net debit, the break-even number 1 is a little bit higher, and then we have a break-even at the lower end, which is so far down below, it's a little bit ridiculous. What I've always noticed, and if I used a more at the money, or only went 20% or 40% or 40%, 30% in the money on the long call, the comparison between them is because it's a leveraged position. Number 1, your monetary maximum risk is always higher. Your percentage at risk of your investment is always higher. Now, what happens in this position if I try to sell a call right away? And this is discussed there. Let's say I wanted to sell the March, let's say a little bit out of the money call. I'm going to try to knock down some of that risk, but let's just say the March 82, let's use the 83. It's between the strike prices. It's got a bid of about $1. We'll use a bid price of $1. What's that going to change my position into that in-the-money long strangle? Okay, let me go ahead and click submit. Oh, I wanted to use $1. My apologies. Let's put that in, shall we? There we go. Fantastic. All right. Now, pretty much know what's going to happen. The risk goes to an unbearable level for me personally, 16.8% of my investment. That's on the upside, the direction I was originally planning on the stock moving. The maximum profit is still high, but that's assuming the stock's trading at about $0 on expiration. And, of course, the maximum risk is now $1,000. It almost tripled in price, and I have a very small profit window. This is not the position I'm going to trade. That doesn't match my personal risk-reward tolerance. That original setup, let's look at what just a little bit in the money put option would be to January 2012. I'm sorry, call option. So I went 1, 2, 3 strikes out here. Let me go down as far as 70 for the call with the stock at about 80 here. Let's use that one, shall we, and just do the comparisons. The conclusions I've always made when I run these scenarios, when it was on IBM, I did another one that was on Noble Energy about a year ago for a customer, and then this one on IWM. Here's another leverage position. Is my capital 4 times almost less than what it would have been on the married put? Yep. My maximum risk is 29.3%. I'm not taking that. If I suffered a 30% loss, if this position went to maximum loss, well, it's going to need a 50% gain to get back to break even on my next position. All right? This is what we're trying to avoid. I can't tell you what to trade. After I did my my analysis, the customer thanked me for my thoroughness, and he said, but you know what? I think this is a better approach for me, doing these in-the-money long strangles and looking for short-term income where I can manage it because the ETFs don't move as much. That's his prerogative. The conclusions I always come to when I do this analysis: number one, the leverage risk is too high for me. Number two, what I've always noticed when I start tracking these two positions side by side in the portfolio is that with normal market conditions, with a stock moving up 5% or just 4% over a 1-month or 14-day period, I can always liquidate the RPM for a higher profit or smaller loss than I could for the in-the-money long strangle. It takes much longer to realize a profit in these positions. Shiva said, can you also send me that email? Yeah, I'll send you that email too. I've got, yeah, got it there. Got your email address, Shiva. Caught myself. I almost read it out loud, and I think you would have been mad at me for that. Okay. But yeah, I'll send you guys that email, both of you, Shiva and David, with the IBM example that I did several months ago, comparing the in-the-money long strangle to the married put, and to the recent one I did on IWM. I think I deleted the Noble drilling one as well. But for my personal preference, I don't like it. It doesn't match what I'm trying to do, and to me, in normal market conditions that I've been watching, the in-the-money married put always, the RPM always performs better. Now, looking at the chart here, just in the in-the-money strangle, is this giving me more opportunity for a larger profit range? Well, sure. IWM, the Russell 2000, if the stock suddenly spikes down to 65 or drops down to $50 per share, or if it goes up to $100 per share, spikes up 30 or 40% from where it is now, this in-the-money long strangle will realize more of a profit than the married put. I can't deny that, and it's a leverage position. Hey, how often do you see the Russell 2000 ETF move 30 to 40% in a 30 to 60-day time period? Very infrequently. And by the way, if the Russell 2000 in that other example we had with that deep in-the-money call when we shorted it against it, we had that maximum profit of about $2,000 if the stock was trading to zero. Hey, if the Russell 2000 ETF dropped down to close to $1 or $2 per share, I think we'd all have a lot more serious problems in the market than what our RPM did or in-the-money long strangle did. That would be something pretty disastrous occurring. All right. Folks, you stayed with me and you bared with my voice and bared with my instruction for an hour and a half here. We're going to wrap up here, so if you have any last questions, just go ahead and send those in. Well, Shiva, if you look at the numbers here, if you look at a maximum risk of 29.3%, and then you assume a gain of what you're expecting to see, and remember this is an ETF that probably won't move 30 or 40% or a 60-day period. I mean, you can go right into the trade simulator tool in RadioActive Trading and play around with that. I don't know what numbers you'd like me to try to put in there, but you can do that at any time. Just go to radioactivetrading.com, go into the resources tool there, and the resources tab on radioactivetrading.com, and play around with your risk-reward numbers, see what it would come out with. I think that we have default settings there for not a strangle, but a bull call or a bear call credit spread or a credit spread in the resources tab, one of the default settings. You might want to use that as a starting point and just reduce the probability from, let's say, 70 or 80% down to about a 50% probability. Because honestly, when I look at a profit and loss chart of an in-the-money long strangle of this type, needing the stock to be, this ETF, for example, to be above 94 or below 61, it's not really true. Let's take more of this one. It'd probably be around 91 here at the halfway point, or below, let's call that 68. And I don't know if the ETF is going to swing that far. I'd say the probability of success with a swing move one way or the other would probably be around 40% or so. I think that would be the range. But yeah, you just play around with that, with starting off with the default credit spread numbers there, Shiva, and see what you get. And then if you have a question, just send me an email tomorrow or later on this week after you've played around with that for a while. All right, I had some problems with this earlier. Let's see if I can get this back up. easily without any issues. Okay, there we go. I'm going to wrap up. If you have any last-minute questions, I'm just going to pull up some other screens here. If you have any last-minute questions, go ahead and send them to me, and I'll try to answer them. I flash up this screen real quick, the services. The PowerOptions tools, the 20-minute delayed service is $59.95 per month, or $600 for the year. The real-time service is $79.90 per month, discounted rate for $800 per year. Like we talked about, if you buy in bulk, you get a cheaper price, you get a discounted rate. We didn't have a chance to talk to the historical suite of tools. I might have a follow-up webinar to the original planned series on trying to use the historical suite of tools to do some comparisons, as we talked earlier, on the weekly setups or just on the RPMs in general, but I'll get back to that. We might do that afterwards. Okay, and the professional level of service listed here, that includes everything on the real-time but unlimited access to your historical suite of tools. All right, our remaining schedule coming up for the Power Options for Radioactive Traders series. Tuesday, February 8th, 9 p.m. That's where we're going to spend the full hour. I'm actually going to say it's going to be an hour and a half. I apologize for getting the time, going over the time, but the last two presentations have been an hour and a half, which I think is great, but I'm actually going to list the next three ones at an hour and a half. So, next Tuesday, February 8th, 9 p.m. Eastern Time, we're going to go through analyzing the results. We're going to take a step back, say, okay, we've run our search, whether it was the dividend search, the income search, just the basic radioactive default screens. Now, how are we going to research and analyze the positions? That'll be next week. The following week, Wednesday, February 16th, 2 days after Valentine's Day, 9 p.m. Eastern Time. Part 4 of this series is going to be using the portfolio tools to track, and we're going to discuss management of the RPMs as well. Not going to give away all the income methods. Not going to go in depth into all of the income methods. We're going to discuss how to use the PowerOptions tools to evaluate them. And then Wednesday, February 23rd, 9 p.m. Eastern Time, Part 5. We're going to have another open discussion, sort of a review, question and answer time on analyzing the results, using the portfolio tool, using the search tool, anything you want to go through. And if we need to, we'll have a secondary follow-up after that, another open discussion to round this out. And then maybe I'll do a bonus one later on just using the historical tools. I'm sorry, I apologize. All right, so questions. We're wrapping up for tonight, but if you have any other questions you think of later on, send me an email to support@powerop.com. But if you have questions at Radioactive Trading, or you have questions for Kurt, remember, just send them to support@radioactivetrading.com. You can call us here at Power Options toll-free during the market hours if you live inside the continental U.S. at 877-992-7971. Or, of course, you can reach us internationally. You live outside the continental U.S., you can reach us at 302-992-7971. Of course, there's also contact links at the bottom of, every Power Options page. Let me write this down. Okay, sorry about that. All right. Okay, let's see here. Oh, okay, two quick questions here. Shiva, the price that you listed me that you were charged for, that might be for the Fission subscription. You might have started your first month of Fission after you purchased the blueprint for the discounted rate of $10, and then you might have subscribed to that. I clicked link to subscribe to that. If it was just $69, that was for Fission. I'll tell you what, Shiva, I'll include that with my email I sent you and see if I can figure out what that was for, okay? And Mary wanted to know about an email that she sent. Yeah, Mary, we saw that. I'm sorry, we did get that email. Ernie saw it, but Ernie actually had a couple meetings today, so he didn't actually read it. I saw it, and I knew the filter you were talking about because you and I had talked about that before, but I didn't get a chance to review it or go through it there. Okay. And yes, Steve, I do have your email written down, so that's where I'll send that to once I take a little bit look into it. All right. Ladies and gentlemen, looks like that's all the questions. I appreciate you staying with me for an hour and a half. I realize I said this webinar was only going to be an hour. Went over time, but I appreciate you all staying with me. Remember, next week, Tuesday, that'll be part 3 of our presentation on using the Power Options tools for radioactive trading. We're going to go through the search and analysis on those positions. Again, if you think of any questions later on, send me an email. Give me a call tomorrow afternoon, and I'll talk to you then. Ladies and gentlemen, have a fantastic evening. Thank you for joining me. Happy trading, and I hope to see you all soon. Good night.